Let's look at a chart to understand how beta works and the concept of the line of best fit. So beta is essentially the slope of a line of best fit of a series of share price movements and market price movements. So we have on this horizontal axis the return of the market, the percent change, and then we have on the vertical axis the percent change for the security that we're trying to determine the beta of. And then we'll go back, say, 2 years and plot all of the weekly data. And then you'll have all these data points. You'll have the data points that reflect the return of the market and that reflect the return of the share price of the company that we're trying to determine the beta of. And then we can calculate the line of best fit. And the beta is the slope of that line. So it can be positive, it could be 0, or it could be negative. But understanding what that slope is will determine how volatile this stock is relative to the market, and whether it's positively correlated or negatively correlated, perhaps, with the return of the market. As a financial analyst, there are 2 ways to get the beta. One is to go on Bloomberg, and using the beta function on Bloomberg, you can simply retrieve the information, and you can make adjustments on the screen in Bloomberg to change the comparative index, to change the time period that you're looking back, the frequency of volatility. The default would be weekly, but you could change it to be monthly or some other period, and you could change it from a 2-year look back to a different amount of time as a look back. That would be one way. Another way would be to download the historical price information for the index and for the individual security. Then in Excel, you can calculate the weekly return of each of them. And using the slope function, you can select all of the data for the weekly returns of each. And the slope function will give you the slope of the line, which is the beta.